Welcome to the Multifamily Investor Nation podcast. I'm your host, Dan Hanford. This podcast is unlike any other podcast you have been listening to. The guests on this show are true, active real estate investors closing real multifamily deals. Whether you are an active investor looking to up your game or a passive investor looking to learn more about how multifamily deals are structured, I promise you will thoroughly enjoy this podcast. So be sure to hit that subscribe button so you'll be notified of future episodes. For those of you that are interested in investing passively in these types of deals, in solid, cash-flowing multifamily deals throughout the Southeast, then visit my group, PassiveInvesting.com. Fill out the investor interest form. That's PassiveInvesting.com. If you've closed a multifamily deal in the past 12 months and want to be on this podcast, then send an email to Stacy@multifamilyinvestornation.com for details. Now let's get started.
Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, and I'm so excited to be joined today by Mac Shelton. Mac, welcome to the show.
Thanks, Whitney. Appreciate you having me.
Yeah, Mac, I know we're here to talk about Mount Pleasant Villas, 90 units in Roanoke, Virginia. But before we dive in to the details of this project, tell us a little bit about yourself and how you got into the multifamily space.
Sure. So I started out my career in private lending and then transitioned to private equity, where I met my current business partner and we were buying companies as opposed to real estate. Did that for about 6 years and was investing in real estate on the side the whole time, basically. My current business partner and I had bought a few rental properties just as personal investments in the same development in South Carolina. And that eventually led to an opportunity to buy a portfolio of those, which we raised some money to do in 2021. And that was the beginning of Sweet Bay. We were both still working full time, but switched to Sweet Bay full time beginning of last year after closing Langdon and Briskwood, which we talked about the last time I was on the podcast.
Are you a serious real estate investor looking to break into the multifamily space? Or are you an experienced multifamily investor looking to level up your game by meeting new passive investors and creating new partnerships? Have you heard of the MFINCon happening in Charlotte, North Carolina, June 12th through the 14th? The Multifamily Investor Nation Convention is a place to learn from over 60 plus high-level speakers and also to network with over 700 serious multifamily investors. If that's not enough for you, A-Rod. Yes, Alex Rodriguez, 12-time Major League Baseball All-Star with over $700 million of commercial real estate, including apartments, will be live and in person speaking at this event. Also speaking is the one and only Dr. Robert Cialdini, the godfather of influence and the award-winning author of the book Influence, one of my all-time favorite business books. Finally, we will have the CEO of Taco Bell, Mark King, joining us on stage to talk about leadership. Be sure to secure your tickets to this live in-person event as the tickets are going fast. Go to mfincon.com to find out more details. There are also sponsorship opportunities available for those of you who would like to have a booth at this event. For the details for this event and to purchase tickets, visit mfincon.com. You can use promo code MFINPodcast, all one word, MFIN Podcast, to get $200 off tickets, and that's mfincon.com. Look forward to seeing you there.
Well, congratulations. And what an interesting time to go full-time in real estate in the middle of this interest rate hike and all the turmoil that's come with that. Mac, let's dive in. Again, we're talking about Mount Pleasant Villas, 90 units in Roanoke, Virginia. Let's start off with, when did you close and what was the purchase price?
We closed on December 1st, and the purchase price was $7.25 million.
Excellent.
I did Sweet Bay full-time really in a tough time to find good deals at the beginning of 2023 with all the interest rate hikes and seller expectations not really adjusting to those interest rates. And after closing Langdon and Briskwood, we spent 6 or 7 months making offers on deals that were either listed or we got a lot of early looks and off-market looks from brokers, but usually the pricing didn't work. And finally, we put together a target list in Roanoke, since we'd already owned there, and sent it to the broker that helped us buy Langdon and Briskwood. And it turns out that one of the top targets we had in Roanoke, the owner called that broker a day or two after we sent him the target list and was interested in exploring a pocket listing. And he already had a buyer lined up that was interested. So we got under LOI, I think 2 or 3 days later. That was in July.
In July. Okay. But yeah, and just for the listeners, anchoring of expectations, having a long closing time period, especially in last year, is not unheard of.
Yeah.
So this property, we've got 90 units. What was the overarching, like the vintage of the property and the overarching business plan here?
So the business plan here was one, as we usually plan to do, there was opportunity to increase rents. When we put it under contract, it was only 90% occupied, and market occupancy in Roanoke is over 97%. So we knew that could be improved. And the primary way that we plan on doing that was by bringing in a better management group. We worked with Greenbrier management in Roanoke already at Langdon and Briskwood and had a lot of success there. So we knew they would do a good job with this property. And the prior owner had removed the on-site staff. And we'd heard from some of the tenants that since that had happened, things had really gone downhill. For a 90-unit property that already had a nice leasing office on site, it didn't seem to make sense to us to not have somebody on site. We've put somebody on site now, and it actually works out great because he can manage our other properties from that office. But really the business plan was improving occupancy, handling maintenance requests and things like that more efficiently because we had somebody on site, making sure collections were actually done on time and the rules were enforced by that on-site staff, and then increasing rents through renovations, both exterior and interior.
Awesome. Awesome. Well, let's talk about how you got to the offer. So you find this property in July. So when did you put in an offer and did you walk the property before you did?
So we put in the LOI in August. My business partner did walk the property first, and then we both ended up doing it multiple times after that. But we put the LOI in August, and I think our effective date on the PSA was the September 5th.
Okay. And how did you structure that deal?
It's structured the same way that we typically do with all of our deals. Sweetbay is the only GP. Majority of the equity comes from our investor network. And the loan on this one was actually an assumption. So there was a Fannie Mae loan already in place at a pretty attractive interest rate. It's in the low fives. And so we just assumed that loan for our debt financing.
Okay. And well, with that, that's fortunate. And I'm sure there's a story there because I've heard that not all assumptions go swimmingly. But anyways, okay, so you've got this property, you've walked it a few times, you put a LOI in. At what point in time, first of all, like what did you put it under contract for? And was that different than what you closed at?
It was. So we put it under contract for $7.48 million. We ended up adjusting that down to 7.25 due to some findings and due diligence, primarily around the tenant base.
Okay. And then how did you structure that? How long for due diligence? How long for closing? Any extensions in there?
Yeah. So we had a 45-day due diligence period. Closing was set for 30 days after the end of that. So it's 75 days total. And then we had a 30-day extension option. And we did end up using the extension option because, as you mentioned, on the assumption, it just oftentimes takes longer than it probably should. The lender just wasn't ready to close according to the initial timeline. So we used that extension option.
Got it. And were you guys the only ones competing on this project, or did you have other people that were competing?
There was one other bid. Supposedly, we haven't heard much about it, and it sounds like it was a really lowball offer that wasn't that serious. So I think we were really the only credible buyer that had looked at it.
Okay. And then how much did you guys put down for earnest money on this property?
We put $70,000 down.
Was that hard, or did that go hard after due diligence?
So it went hard after due diligence. The only contingency that remained after due diligence was around the assumption, because we were concerned, given that occupancy was at 90%, that could cause issues with the assumption. And since we couldn't control that until we owned the deal, we didn't want to take the risk on that ourselves. So we structured it with basically an assumption contingency, but the rest of the hard one, the earnest money would have gone non-refundable at the end of due diligence for any other reason besides the loan.
Got it. Got it. Let's talk about due diligence. What did you guys find on physical due diligence? How did that go?
It went mostly as expected. Like I said, we had walked it at least before putting it under contract, and we actually got some reports that the seller had done for refinancing before we even signed the contract. So we knew what to look out for already. The only surprises, one big thing that ended up adding to our CapEx budget was around security measures, like we were going to add a fence and some cameras and lighting and things like that we didn't initially plan for, that were a result of some of the behaviors that we saw on site when we did some of those inspections. But in general, it went mostly as planned.
And did you walk every single unit?
We did. So the way that we typically do it is usually one of us will drive the property at least before we put it under LOI, unless it's in a market that we already really know. And once we're under LOI, we'll do our initial, sometimes it's before LOI, but we'll do an initial tour where we'll try to get into at least one of every floor plan and typically try to see a renovated and a non-renovated version of each floor plan if there have been renovations done. And then we'll use that to formulate a check sheet that's got all the details that we would need to formulate a complete renovation budget when we do our full unit inspection, where we do walk every single unit. So once we got under PSA, we took that check sheet and went with a property management company and looked at every single unit and checked off the items that needed to be replaced in a renovation.
Got it. All right. Sounded physical due diligence wasn't a whole lot of surprises there. Let's talk about the financial due diligence. It sounded like we might have a story here.
Yeah. So the financials, one of the big upsides, as I mentioned earlier here, that we saw was just related to property management. The property management company that was in place before has one bank account for all of their properties. So you can't pull bank statements to compare to verify cash and things like that. It wasn't a sophisticated set of financials. So that did have some headaches to it, and we're still discovering some things, nothing too major so far, which has been good. But the biggest discovery and due diligence that really forced us to change the price was when we signed it up. We were told that there were 2 or 3 subsidized tenants, which we weren't concerned with. And we later found out there were 23. And there's not a perfect correlation between the tenants that we had later found to be problematic and the ones that were subsidized, but there's certainly a higher in that category, right? And we realized during due diligence that it wasn't necessarily going to change where we could take rents or what we could sell the property for when we did go to exit, but it was going to delay us getting to those rents, right? Because to charge the rents that we're planning for this property, we need tenants that in a lot of cases probably wouldn't have been comfortable living there with the tenant base that was there when we bought it. And so that's just a delay to the overall business plan because we have to clean up the tenant base before we can really push rents. So that's what ultimately led to the adjustment in price.
Hey guys, it's Dan Hanford. I wanted to take some time to introduce you to our group at PassiveInvesting.com. We are a national private equity real estate firm based out of the Carolinas. We focus on acquiring institutional quality apartments and self-storage facilities. We do this with private accredited investor funds and have a portfolio of over $700 million in assets and control over $250 million in equity from our investors. PassiveInvesting.com makes it easy for you to start investing in real estate without all the hassles. We even have an average 62% repeat investor rate in each offering that we put together. In addition, we also have a real estate debt fund that offers hard money loans to local fix and flippers across the U.S. called RehabWallet.com. It currently has a 0% default rate. To help you learn more, we have put together a free passive investor guide that outlines the 7 red flags for passive apartment and self-storage investing. Visit PassiveInvesting.com/red flags to download the PDF now. That's PassiveInvesting.com/red flags.
And did that impact the assumption at all?
No, I think that the assumption required at least 90% occupancy, and at closing they were at 90.6. So we checked that box. They didn't really care about the tenant base as much as long as the occupancy was there.
Got it. Let's talk about the terms of the assumption. So you assumed a loan, and for any listeners here that don't understand what that is that you're taking over the loan that's currently in place rather than sourcing new debt for the property. What was the interest rate on the loan? What kind of debt was it? And then at what point in the debt cycle are you taking over the debt?
So the loan was at a 5.9% rate fixed through the end of 2029, I believe, or midway through 2029. So it's about 5.5 more years left on it. The balance was just over 5 million. It worked out to a 69% loan to value on the final price and 30-year amortization. It's a typical Fannie Mae loan in that regard. So we obviously that's better than anything we would have gotten in the market at the time. So that was a plus. We won't pay a different price for a property necessarily because it's got assumable debt, right, than we would otherwise. Because if you do that, you can end up in a situation where when you go to sell, the next buyer is probably not going to have that financing available. So you need to make sure that no matter what your financing plan is, your cost basis still makes sense given the overall market environment at the time that you're purchasing the property. But it definitely makes the cash yield better on this deal. We're expecting over 9% cash yield once we get through renovations.
And I love the fact that you bring up that point, because I know a lot of operators are looking for assumable debt right now in order to have a higher cash arbitrage. But I have heard of some operators overpaying for property because of that reason. And so I think that's a huge guy. If listeners didn't get anything else from this episode, it's that. So thank you so much for sharing that.
On that point, one of the things that really got us excited on this one is we had already lost 4 or 5 deals just before this that had assumable debt that were marketed, right? So we had a lot of competition, and we had basically come to the conclusion that we were never going to win an auction on an assumable deal because there were just too many other buyers out there that were willing to pay extra for the financing, and we weren't. And that was one of the reasons this was so attractive, because we were basically the only party bidding.
Now, this is a question I don't normally ask, but I'm going to ask here, especially given your background in financing. Are you positively arbitraged on this? Is the cap rate higher than the debt that you took on?
The going in cap rate is not, but the pro forma cap rate certainly is. I think the going in cap rate, I've got it right here, actually. I guess technically we were, yes. The going in cap rate was 5.6. And the loan's at 5.2. If you actually incorporate the amortization into a debt constant, then it's probably still slightly negative leverage. But on a pro forma basis, it's certainly positive leverage. And that's typically how all of our deals look. Our going in, we don't focus that heavily on the going in cap rate because we're really not buying the financials, right? We're buying the potential of the property and what we're going to do to it. You've got to be careful with that so that you're not paying for all the value that you're going to create. But ultimately, we care much less about the cap rate on the T12 financials than we do about the cap rate on what we're expecting the property to generate.
Awesome. Thank you so much for sharing on that. Let's talk about how you worked with your limited partners on this deal, because you did raise capital.
Yeah.
How much capital did you raise for this deal?
We raised $3.6 million.
And how did you structure this with your limited partners?
We used our typical structure, which is so there's some fees that we charge on, like everybody, acquisition, asset management fees that are pretty minor. The promote structure here was a 30-70 split, so 30% of profits to the GP once you hit a 7% IRR. So any profits above a 7% IRR, we get 30% of. And then if we get above a 16% IRR, we get 50% of the profits above that.
Okay, so you got a preferred return. You have a couple of different, it sounds like you have a 70-30 split with 2 waterfalls in there before it goes to 50-50. And you mentioned that you charged some fees to this deal. What kind of fees did you charge, and what was the percentage?
Yeah, so we charge a 2% acquisition fee on the overall transaction value. So we include, for example, the renovation reserves that we raise up front in that number. And the way we justify that is buying a deal where your renovation budget is only 5% of the purchase price is going to be less work for us than one where the renovation budget is 50% of the purchase price, right? So we charge 2% on the overall transaction value as an acquisition fee. We charge 2% of monthly effective gross income as a management fee, and then 1% of the sale price at exit.
And since you are doing a value add strategy and there's some construction, is there a construction fee in there, or is that absorbed into the initial acquisition fee?
It's just absorbed in the initial acquisition fee. Yeah, we don't charge a construction management fee.
Okay. Now, just in wrapping up, what was something that you thought was going to be easier on this transaction that actually was a little bit harder, more difficult? And then let's flip that on its head. What did you think would be more difficult on this transaction that actually ended up being a little bit easier?
The assumption is probably the answer to the first one. Really, the assumption in the closing. I was actually hoping to use some 1031 proceeds from a personal sale on this deal. And if things had gone according to the initial schedule, I would have been able to do that. We also would have closed the deal before I got married in November, which didn't happen. So
congratulations.
yeah, fortunately, I've got a great business partner that took over while we were on the honeymoon and got us closer to closing when I got back. But we were planning on closing this on a timeline where all of that would have been done before the 1031 expired, before the wedding, and it ended up not working out that way because the assumption just took longer than we expected. And as far as what was easier that we thought would be harder, I probably have a different answer on this than my business partner would. I was a little bit concerned about the equity raise just because it was the biggest one we'd done so far. We had our network should be good for at least $5 million of equity on any given deal. So it shouldn't have been an issue, but it was the biggest raise we'd ever done so far. And we actually, as part of the price adjustment, what we gave in exchange was waiving the rest of due diligence and making our deposit non-refundable. And when we did that, we still had about $1 million to raise. So I don't know that I would have done that if my partner hadn't been as confident as he was that the money would be there. Turns out he was right. And we actually were 30% oversubscribed in the fundraise. So I'd say that was easier than I expected it to be.
Awesome. Now I'm curious, since you missed your timeline schedule, what did you do?
I'm just going to have to pay taxes on it. It was a pretty small deal, so it's not huge, but I'll just end up paying the boot on it.
Why not go into a passive deal and use the losses to offset the income or offset the taxes? I'm curious. I wouldn't have had one because pretty much all of my personal liquidity is earmarked for sweep pay deals. And two, because I just wouldn't have had time to find something. By the time we found out that this wasn't going to close before my deadline, it was like 2 weeks before the wedding. So I had all that to deal with, and we still had diligence going on. We were still raising money. It wouldn't have been worth the effort to save. It's probably going to be less than a $10,000 tax bill. So it won't be that big a deal at the end of the day. Well, and making a high pressure decision like that with very limited options, it sounds is not a good position to be in. So I completely understand. Mac, thank you so much for sharing your knowledge and expertise with us here today. If people want to find out more about you, how can they do?
You can find us at our website, www.sweetbay-capital.com. We're also on LinkedIn. Our page is just Sweet Bay Capital. And then you can find me on LinkedIn, Mac Shelton, is my profile.
Excellent. Mac, again, thank you so much for sharing your time with us here today. And we look forward to hearing about your future deals.
Thanks a lot, Whitney.
Thank you for listening to the Multifamily Investor Nation podcast. I trust you enjoyed this episode. Take a moment right now to leave us a review and let us know what you learned. Also, don't forget to visit passiveinvesting.com and fill out the investor interest form to invest alongside me in excellent multifamily assets located across the Southeast. That's passiveinvesting.com. Thanks again for listening, and we'll see you on the next episode.